Welcome to the Lauder Institute at the University of Pennsylvania. I'm Jules van Binsbergen, director of the Institute and a finance professor at the Wharton School.
And I'm Jonathan Berk, a finance professor at the Graduate School of Business at Stanford University. This is the All Else Equal podcast. Welcome back, everybody. Welcome to the new season of All Else Equal. We have some news to share with our audience. Jules, why don't you start and tell us the new position you've taken?
Thank you, Jonathan. Since July 1st, I'm the new director of the Lauder Institute, which is an institute at the University of Pennsylvania that offers students a joint degree program, an MBA from the Wharton School, as well as an MA degree in international studies. And so it brings together two key areas that train students to be global business leaders, as well as global political leaders. We're really training Lauder students to be diplomats in the broadest sense of the word. And I think those skills are in very high demand, particularly in the current day and age.
And also, Jules, the Lauder Institute has stepped up to the plate and sponsored All Else Equal. And I think it's a great partnership because the concepts we speak about are absolutely applicable for global managers. And so I think it's a great partnership.
I'm very happy that the All Else Equal podcast will be a Lauder Institute podcast, in addition to being a Stanford podcast. In fact, the first guest that we have today in the podcast is a global senior fellow at the Lauder Institute. I think that there are many geopolitical themes that we have talked about in previous episodes, and we will undoubtedly talk about them in future episodes. And those themes fit very well within the academic mission of the Institute.
Yeah, let's start with one of the most important geopolitical themes, which is national debt. And that's what we're going to talk about today. Jules, why don't we start from a naive perspective? If you look at debt levels of market economies, what you find is that government debt has always increased. If you look at the United States, there have been a few times when the debt levels have decreased, but generally, US debt has been on an upward trajectory since independence. So the question then is, what's the fuss about? It's always been increasing.
Yes, indeed, Jonathan. If you look at the numbers, we're currently hitting a level of $34 trillion in debt. And that's one of the highest numbers that we've ever seen for US debt. But the question is, are these raw numbers all that interesting? And the reason why I'm saying that is, in growing economies, all of these numbers will hit all-time high records all the time. Meaning, if we would look at US GDP hits as a total size number, as a flow number, US GDP constantly hits all-time high numbers. And every time we have growth, it grows by another 1 or 2% and becomes an even bigger number. The same is true for the stock market. In a growing economy, the stock market will constantly hit new records. And so the question is not so much when we think about the national debt, whether or not that level is high, but whether it's high relative to some other quantity that we think is the relevant quantity. And one thing that we need to discuss today is what that other quantity needs to be. Let's start with the one that almost everybody uses, the ratio of national debt to GDP. If we look at that ratio, there may indeed be reason for concern because that ratio is hitting all-time high levels as well. Just to give you some numbers, in 1975, we were a little under 40% of GDP, and in 2024, we're now over 120% of GDP in terms of the debt level.
So by that measure, it does look like we have reached levels of debt that have been unprecedented. But you know, Jules, both of us are finance professors. One of the things that we keep discussing is the ratio of debt to GDP is a very strange ratio because the numerator is a stock measure, the level of debt, and the denominator is GDP, which is a flow measure, the amount of domestic product produced in a year. And we don't usually measure things by putting stocks over flows. So, example, a company, if we want to know the level of debt, we'll put debt to assets of the company. If we want to put flows on case, then often we'll put interest coverage over, say, earnings. So it's flow to flow and stock to stock. So, Jules, it doesn't seem to me that the measure that people use is such an informative measure.
There are circumstances in which stock to flow measures could be interesting. We have certain valuation ratios like price earnings ratios and price dividend ratios that we sometimes use. But I think you're onto something, Jonathan, because in this particular case, depending on what we compare to what, we're going to get very different answers. And so maybe particularly in this example, this stock to flow measure may actually not make the most sense. One thing that we could look at, consistent with your example, is to say, let's take the national debt and divide it by some measure of assets. And then we can think a little bit about, as a country, as the US, what would be an appropriate measure of assets? Maybe a measure of total wealth would be a good one to use. Although we know that measuring that fully is hard, we can certainly get at certain pieces of it. So let me tell you some pieces that are not that hard to measure. For example, we can look at the total stock market capitalization of the United States, so the collective value of all the equity. We can look at what the total residential housing stock is worth and how that value has developed. And once we take ratios like this, it turns out that the national debt to the total stock market capitalization of the United States is actually pretty flat since 1975. It hasn't increased, right? So let's again recall those numbers from debt to GDP from 38% to over 120%. If we look at the debt to the stock market capitalization, we have a number a little bit below 1 pretty much throughout the entire period since 1975. Of course, during the internet boom, that number was low because the stock market valuation was so high. And then that corrected again during the financial crisis when it went back to similar numbers like the ones that we had in 1975. If I do the same thing with national debt to, say, the value of the residential housing stock, you're going to get that the numbers look pretty flat. It doesn't look that alarming at all in terms of how much the debt of the United States has increased.
And so what about the flow-to-flow measures?
Well, so we can think a little bit about what flow-to-flow measures we would like to use. But indeed, one thing that we could do is we could use the total interest expense to GDP ratio. And what is interesting there is that the amount of dollars that you need to pay in interest is going to be a product of the outstanding debt that you have times the interest rate that you need to pay on that debt. Overall, if we look at the total interest expense to GDP ratio, it is going to be pretty flat.
Let's take a step back here. We have one measure that's exploded. We already are worried about that measure because it's a stock to flow. So then we say, okay, let's look at the flow to flow, stock to stock measures. Those are two completely different measures, but they both are flat.
Yes. So the question is, what can we learn from that? Now, first, if we lived in somewhat of a stationary environment, and that's an economic term or a statistical term that people use when we mean that variables that vary over time seem to revert to some long-run mean and therefore do not seem to have important trends in them. It doesn't really matter which any of these measures you use. You could even use a stock-to-flow measure. But the thing is that particularly over this time period that we're talking about, a lot of these quantities haven't behaved in quite that stationary manner. And that means that the answers we're getting from these different measures is just going to be really different.
So let's just bring this down to an example. Let's say we want to use the price earnings ratio to measure value of a company, right? And if we're in a world where all companies are kind of the same, then that stock to flow measure is a fine measure to use. But if we're in a world where some companies are, startups and other companies are mature, we're going to have a big problem with that measure.
Absolutely.
Right? There are very fundamental differences. Essentially, we're saying that the stock to flow measure works when ratios stay about the same.
Yes.
When ratios don't stay the same, the stock to flow measures fail dismally. Let's think about this in terms of countries. So one of the big puzzles is, why does Argentina default at a 40% debt to GDP ratio, whereas Japan has a 250% debt to GDP ratio? Nobody's even thinking about the possibility of Japan defaulting. With a clear difference between those two countries are interest rates.
Absolutely. Japan has an incredibly high, one of the highest debt to GDP ratios in the world. But of course, everybody also knows that interest rates are at absolutely unprecedentedly low levels for a very long time in Japan. Now, recently, they've come up a tiny little bit, maybe by a percentage point or so, and the interest rates were essentially at zero for a 20-year period before that, which means that if you would compute the interest to GDP ratio for Japan, you would end up with an incredibly low number, despite the fact that the debt is so high. And so that really makes you wonder, what would be the correct measure for us to measure sustainability of debt? But suppose that for whatever reason interest rates in Japan would go up substantially, Japan will have to roll over that debt at those new rates, and that might lead to a different situation. Now, the question is, why are the interest rates so low, and will they stay low exactly because of the circumstances that Japan is in? And so that is a general equilibrium and all else equal discussion that we need to have here in terms of what drives those low interest rates.
Yeah, so that's certainly another episode. I mean, the question you're raising is, are interest rates low because Japan borrowed a lot of money? Or is Japan borrowing a lot of money reflecting a low interest rate environment? A naive view would say something like, well, if interest rates are low, isn't the optimal thing to borrow money?
Yeah. And you could also say, well, if somebody borrows a lot of money, shouldn't that at some point lead the interest rates to be higher? There's also the macroeconomic linkages that we need to think about. Maybe interest rates are low for Japan because the growth outlook is so low, right? Coming back to the assumption of stationarity, I think there's certain quantities that have been trending in very non-stationary ways for a long time now for many countries in the developed world, which is demographics. The demographic developments, we've had growing populations in most of these places for decades, and then gradually that population growth has stopped and now even has turned into population shrinkage in many places. If you think about Japan peaking at 120 million people in 2010, by the end of the century, the United Nations predicts that they have 70-something million people left. So that is a drastic cut in their population size. The big question is, to what extent do population dynamics interact with interest rate dynamics?
And that cuts to maybe, as economists, we don't fully understand what's going on, but the market itself understands that. Japan is able to keep borrowing at very low interest rates because somehow the market understands these dynamics. And so I think this is a good time to introduce our guest, because our guest has been a bond investor his entire life.
Our guest today is Mohamed El-Erian. Mohamed was CEO and co-chief investment officer of PIMCO, one of the largest fixed income investors in the world. He's currently president of Queen's College at Cambridge and chief economic advisor at Allianz, which is the corporate parent of PIMCO. And most importantly, Mohamed is currently a global senior fellow at the Lauder Institute. So Mohamed, thank you so much for being with us on the podcast. It's really wonderful to have you.
Thank you for having me.
Thank you, Mohamed. We really appreciate it.
So what we want to talk to you about today mainly is the sustainability of the fiscal position of the United States in the context of the large debt buildup that we've seen, at least measured by taking the ratio of the US debt to the GDP. So I think what many investors and people are worried about, and our students as well, is why are bond markets still willing to lend money to the US at quite low interest rates, despite the fact that, one, this debt to GDP ratio is as high as it is, and we are at this point even running primary deficits with no indication of this changing in the near future.
Yeah, I mean, there's reason to be concerned about the fiscal situation. The easiest way I think about it is that it would have been unthinkable for the United States to go 30 straight months with the unemployment rate at 4% or below, and yet we have a fiscal deficit of 6 to 7% of GDP. That combination would have been unthinkable. To use John Kennedy's words that ECB President Lagarde likes to mention, you fix the roof when it's sunny. When unemployment rate is so low, the economy is sunny. You're not supposed to run large fiscal deficits. So I understand that concern. I also understand the concern that Herb Stein famously summarized by saying, what is unsustainable will prove unsustainable. There are two qualifications. One is the time frame, and the other one is the relative comparison, not the absolute one. So let's start with the second one. The reason why the US interest rates are so well behaved is that in relative terms, the US is what you can think of as your cleanest dirty shirt. Imagine that you are on a trip, you have packed exactly for the duration of the trip, your trip is extended, what are you going to wear? You're going to wear your cleanest dirty shirt. So while the US is not pristine, in terms of its economic characteristics, it's a lot cleaner than elsewhere. So the US will tend to attract funds into the bond market. And after all, it is the deepest, it is the market where others are willing to outsource their savings to. So the US will always have that inherent advantage. So that's the first element. And it's, of course, helped by the fact the dollar is a reserve currency. The second element is time. You cannot replace something with nothing. It takes a very long time to build an alternative system. So what's happening right now is no one is challenging the US at the core of the system, but they're building little pipes. These little pipes fragment the system, but don't completely replace the US. So yes, we should worry about fiscal, but it is not a day one concern in terms of disorderly markets, in terms of the US being rationed from foreign capital.
Mohamed, let me take a step back here. If you look historically, the US has always, in periods of where it had borrowed a tremendous amount, run primary surpluses and paid it back. And I think that's the reason we can still borrow at the rates we are borrowing at, because to first approximation, we've never defaulted. But I look at this and I look at the current political situation, and I really don't see any path right now to primary surpluses. I mean, in my interpretation, the bond markets they're saying, no, history is going to be representative of the future. And what we're seeing right now is temporary. You think that's true?
So first, I think the bond markets also learned from Japan. Japan ran a debt to GDP that was enormous and somehow continued to manage it. The market has also learned from quantitative easing, the notion that you can have a central bank that comes in and buys up to 9 trillion of government bonds and mortgages. Mm-hmm. So most people in the market would agree with you that as yet there is no path to primary surpluses. There is no path to turning the debt dynamic, but they say we have time to find that path. So that's the way the markets are thinking right now. Some feel that that is complacent. Others feel that that is realistic. I'm somewhere in the middle. I do believe that we need to find a path to better fiscal sustainability. You know, Jonathan, it's part of a bigger change. When I grew up, life was easy. The domestic policy stance was governed by the Washington Consensus. In order to grow in a sustainable fashion, you needed liberalization, deregulation, and financial prudence. Today, liberalization has been replaced by protectionism and sanctions. Deregulation is being replaced by industrial policy, and fiscal prudence is being replaced by fiscal irresponsibility. So it is a much broader change in the domestic economic paradigm.
I can't agree with you more. I mean, it's worrying to me because, you know, as I like to tell my students, only one system works. All the other systems fail. And that system worked for us very, very well. There is no other system.
So, Mohamed, you brought up Japan. One thing that I've started wondering, and that Jonathan and I have been discussing too, is the debt to GDP ratio actually the right number to look at? Because there are two other measures that you can think about. The first one is there are annual interest expenses that you need to pay, and you can take the interest expenses over GDP. Those are both flow measures rather than the ratio of a flow measure and a stock measure, right? Because the debt is a stock measure and the GDP is a flow measure. The other way to think about it is that whenever we think about how we finance ourselves, whether it's with debt or with equity, also at a corporate level, we take a ratio of, say, a stock measure of debt to some wealth measure, debt plus equity, or some other bigger measure. And obviously, in the United States, stock markets are incredibly highly valued. Housing markets are incredibly highly valued. So perhaps if you take the debt to total wealth ratio, it may actually look quite fine. I don't know whether anybody's properly done those calculations, but how do you think about this? Should we even be looking at debt to GDP? Is this the right ratio to look at? And maybe do you know historically why that became the measure to look at?
So first on Japan, the three measures you cited, which was the stock measure, the flow measure, and then the broader balance sheet measure, were all debated quite a bit 15, 20 years ago, before Japan entered negative interest rates and everything else that pushed back, because fundamentally you were taxing creditors and subsidizing debtors.
Yes.
And in a regime like that, this regime of financial repression, you can continue. But you're absolutely right. So what we really are looking for is debt sustainability.
Yes.
And the shortcut to that sustainability has become debt to GDP. But debt to GDP doesn't measure a few things. First, it's not netted usually against the wealth of the country.
Yes.
And the argument for not doing that is ultimately the government cannot claim the wealth of the private sector. The wealth of the private sector has a way of going away, going elsewhere, as lots of developing countries have tried. So that's why people say, yes, in theory, that's correct, but in practice, is it really right? The second element you're right is debt servicing, and in particular, interest servicing. How is that relative to your earnings? So normally it's your interest payments relative to what it is you collect. And then the third element is the element of vulnerability. You can have, and we have had, a complete sudden stop on financing that has nothing to do with you, that has to do with a shock elsewhere in the system, and suddenly you cannot refinance your debt. And that in itself can cause a debt problem in a big way. So,
Yes.
Jules, you're right. Debt sustainability is a much broader concept than simply debt to GDP. And getting out of debt sustainability is also a much broader concept than simply running fiscal surpluses. I keep on reminding people, even if you limit yourself to the debt to GDP ratio, you have a denominator. And there's 4 ways to deal with excessive debt. The best way is to grow out of it. The equivalent for an individual of getting a second job and paying off the credit cards and being able to maintain the standard of living. If you can't do that, you can opt for austerity. But we have found that after a certain point, austerity becomes counterproductive. The third is financial repression, but that requires you to fool a lot of people for a lot of the time and distort your system. And the fourth is an outright restructuring or default. And when you put them in that order, it's clear that growth, the denominator of the debt to GDP, is really important when talking about debt sustainability.
And I think it's a good time to start talking about growth. So, Jules and I are pretty pessimistic, at least in the short term, about certainly world growth and also US growth. I mean, we have a demographic problem on our hands, as all Western countries do, and actually also Eastern countries. And then add to that our current issues with immigration. I mean, historically, I would have said, okay, big deal, America has a demographic problem, but we can easily solve that. We're a nation of immigrants. The extent to which we walk back on that, then you really wonder, where's the economic growth going to come from?
Yeah. Look, I used to be pessimist. I must say I'm less so today. And let me explain why. It's not because there is something that's going to change or move the needle in a fundamental way over the next 12 months, but there are things that will move the needle in a significant way over a 3 to 5 year horizon. And governments are realizing this. So take the UK government as an example. They've been stuck in a low productivity, low growth equilibrium. And the incoming new government has put growth as a mission. And there's 2 elements to the mission. The first, they call release the brakes. Take off the constraints on current obstacles to growth. For example, planning rules and trying to increase the supply side. And then there are the future drivers of growth. So you don't just release the brake, but you enhance the engine of growth. And here's where my optimism comes in. Think of a world that's shaken from above and from below. Above, you've got 3 massive transformational enabling innovation that I certainly believe will change not just what we do, but how we do it. And I'm talking here of technology, and particularly AI and a different type. I'm talking about life sciences, and I'm talking about sustainable energy. And then from below, you have certain sectors that historically have had massive positive externalities that are being forced to adjust. Think of healthcare, think of defense, think of food security. So if I look forward, I have this notion we're on a very bumpy journey to a better destination as long as we can navigate the journey. And that's what I feel. So yes, there is nothing that's going to move the growth needle in a significant way in the next 12 months, unless it's irresponsible sprint for growth that will end up in tears. But there is quite a bit to make you more optimistic if you take a longer time frame.
And so the demographic decline is not something that worries you from a growth point of view, because historically, I do think that population growth and economic growth have had important synergies. And first of all, GDP itself, because it's GDP per capita times capita, if you just have population growth, you get part of your GDP growth for free, right? And so if we think about growing out of the debt to GDP ratio measure, and you would think that's the right measure, then you just get GDP growth from having your population growing, and you can essentially deal with a lot of debt even today. But that, it seems, is largely over for most countries. Even for the US, I think population growth has slowed down tremendously. You think that the big engines of growth that you just mentioned will be enough to get growth back to levels that we've seen, say, 20 years ago, 30 years ago?
I mean, both what you and Jonathan said played out in the US in the last couple of years, where there was a massive positive supply shock to the labor market. Many illegal immigrants coming in, enhancing the labor market, maintaining wage growth relatively low. And that has allowed what a lot of people call US exceptionalism, or at least has supported what a lot of people call US exceptionalism, and the extent to which the US has outperformed the rest of the world. So I don't disagree at all that in a world where there's a flow of new labor, if it's productively utilized, then you can increase your growth potential. I completely agree. But that's not the reality we live in anymore. I remember many years ago, I was taking an entrance exam to the University of Cambridge. I was at school, and the first question I had to answer was, quote, "With every pair of hands, God sends a mouth. Discuss." And the idea was trading the productive element versus the needs of a population, especially as it ages. So if you look at capital, labor, and then multi-factor productivity, then you can't rely on labor to be the driver of growth. You're going to have to rely on the other two.
Absolutely.
And that's where my optimism comes in relative to where we are. You know, we all have a huge obligation, because if we don't believe in these new tools of productivity, then we're leaving the next generation low growth, high debt, high inequality, and a climate crisis. Hopefully, we're also going to leave them with tools to manage all that better than we did.
Well, I mean, let me just say that I don't completely share that optimism. I agree we are leaving the next generation with a problem, but unless the government is prepared to think about putting in place policies that are going to increase it'd be great if AI works out. And of course, if AI works out, we're fine. It just seems a little bit too good to be true.
Well, I'm also quite worried about the geopolitical stability of the system that we've had in the last couple decades, and to what extent those geopolitical relations will stay in place and what that will imply for the United States. Right. So to give you one example, I think that it's clear that the future of warfare and of international stability from that point of view has changed markedly since the introduction of AI and the use of drones in combination with AI. And I do therefore think that the US is in some sense in an arms race with many other countries. And the question is, can the US win that arms race? And I'm actually wondering to what extent very large government investments in that technology will be required in the short term, making the fiscal situation even more dire potentially. But that may be worth it. I don't know. Do you have thoughts on this, on how all of this interacts with the geopolitical risks that we're facing?
So first, the US is way ahead of other countries in terms of putting resources into all this. The CHIPS Act, the IRA, all that. A lot of people feel that actually we've committed too many resources to all this. Look, I think of this in a simplified manner as the 80-20 problem, that these innovations, and especially AI, has 80% that's good and 20% that's bad. And the 20% that's bad certainly includes enabling non-state actors to acquire weapons that otherwise they wouldn't be able to acquire, and smart drones and the like. So typically, when you go to those involved in the innovation, they say, guys, you're looking at 80-20. The whole focus is on the 80. We will do good. Go to Europe and face them with an 80-20. They'll be obsessed with the 20, and they want to regulate because they're so scared of the 20. The truth is, you've got to embrace the whole distribution. You've got to recognize that your challenge is both to unleash the 80 and risk manage the 20. And you can't just do one of them on this. So yes, but I remember, if you look back, and I'm sure you have, if you look at the steam engine, if you look at the car, there was always the notion that this was going to create harm in this. And we've learned over time to get the 80-20 right. Now I'm hoping the same thing.
No, I agree with you there. I think we're way too focused on the negative and not thinking about the positive. Or in fact, I would say it a bit differently. We take the positive for granted and we don't realize, wait a minute, the lives we lead are all a result of this. Let me change the subject for a moment. You mentioned various different ways out of our debt to GDP problems. One of the ways is inflation. What do you think the long-term outlook for inflation in the US is?
So, as everybody knows, we went from a world where the problem with inflation was that it was too low to a world where it was too high. And now we are transitioning back to a world where inflation is just right, with a question mark as, does it settle around there or not? My own view, and I'll summarize it in a very provocative fashion, that if central banks could revise their inflation targets, which are all anchored on 2%, they would choose a higher equilibrium inflation rate, that they would choose closer to 2.5 to 3. Why? First thing is because we're no longer living in a world of deficient aggregate demand. We're living in a world of deficient aggregate supply. Secondly, the geopolitics we talked about is fragmenting the system. Supply chains are increasingly becoming less commercial in design. They are being influenced by national security consideration.
Yes.
So when you think nearshoring, friendshoring, thirdly, companies, having been burned quite a bit during the pandemic, are now trying to build in more resilience in their supply chains. So again, this is no longer just-in-time inventory management. This is resilience and not just efficiency. If you were to put all this together, the equilibrium inflation rate for the system is higher than the 2% target that we have. So this is a more inflationary world. It's not a world where inflation expectations get de-anchored, but it's a world that if central banks are not careful, they maybe end up pursuing an inappropriate inflation rate.
I would actually have to say I agree with most of what you just said. I'm not a macroeconomist. As I tell people, I know absolutely nothing about macro. But I will say this. I think the people that spend their lives thinking about inflation do not spend enough time thinking about supply chains.
I completely agree. And you would have thought after the pandemic,
they would have said, wait a minute, look what happened.
Yeah. I mean, we learned 3 things during the pandemic that somehow we're forgetting. One is that supply chains really matter.
Yes. Yes.
2 is that we can supplement our normal data sources with really interesting high-frequency data, which we had to do during the pandemic. And then the third thing we learned is that public-private partnerships can be really powerful, as the vaccine discovery and dissemination showed us. But somehow, as we have gone back to normal, all 3 lessons are seeming to have much less of an impact than I would have expected.
Agreed. I agree with you entirely on that. I mean, let's just say the following, that I think what we've seen in the United States in the last few years is something we've never seen before. We've seen deficits, huge deficits, but they're always associated with war. It's like we've had a war without the war.
Well, you can also say that the United States, perhaps through proxy wars, is involved in many military conflicts right now, right? Let's not forget that.
But nothing at the level of the wars that require deficits.
That is true.
Like the Civil War, the World Wars. Anyway, I mean, my worry is that if you think about that analogy, when the war ended, there was a huge sigh of relief in the country, and everybody said, okay, let's get back to work, right? I don't see that huge sigh of relief coming. But again, who knows?
I think the big difference is, I agree with you, but I'll take it one step further if I may, is that when we had an explosion in debt and spending and fiscal deficit, it was understood that it was justified, but that we will need to reverse it over time. This time, most of the explosion that happened in response to the pandemic was seen to be justified, but there was no common understanding that it needs to be reversed. So you settle at the much higher debt level, and then you keep on climbing from there. There isn't this notion that we need to reverse what was an exceptional increase in the use of the public balance sheet.
And to come back to something you said earlier, I think that there's certain lessons that we could have learned from the pandemic. It seems that those lessons haven't been learned and we're mean reverting to the past. And there are other places where since the pandemic, we are not mean reverting to what was common sense before. In that sense, maybe we're getting the worst of both worlds, and that does concern me. I do think that also for younger generations, the post-pandemic world does have structural shifts compared to the ones before. I think things have become normalized that we hadn't seen for a long time, and perhaps a structurally higher deficit is part of that.
No, I agree.
Thank you so much for joining us on the show.
Thank you very much for having me.
Thanks for listening to the All Else Equal podcast. Please leave us a review at Apple Podcasts. We'd love to hear from our listeners. Also, be sure to catch our next episode by subscribing or following our show wherever you listen to your podcasts. For more information and episodes, visit allelseequalpodcast.com or follow us on LinkedIn. The All Else Equal podcast is a joint production of Stanford University's Graduate School of Business and the Lauder Institute at the University of Pennsylvania. It is produced by University FM.